The balance sheet is one of the essential financial statements that reflects the financial position of a company at a specific point in time. It is also known as the statement of financial position. This statement consists of three main parts: assets, liabilities, and equity. Assets include everything the company owns, such as cash, inventory, accounts receivable, and property and equipment. Liabilities represent the financial obligations of the company and include loans, accounts payable, and other payables. Equity shows what remains of the assets after deducting liabilities and includes paid-in capital and retained earnings. The purpose of the balance sheet is to provide a clear picture to investors and financial analysts about the sources of funds used in the business and how they are distributed between assets and liabilities. This statement offers a comprehensive view of the company's ability to meet its debts and achieve future growth. Understanding the difference between a budget and a financial statement is crucial for both individuals and businesses. The terms are often used interchangeably, but they represent distinct financial tools with different purposes and functions, although they are related. A budget is a financial plan for future income and expenses over a specific period, often a year. It is a forecast that helps individuals or organizations allocate resources, plan for future needs, and control spending. Budgets are dynamic and can be adjusted during the period based on actual income and expenses. They provide a framework for financial discipline and decision-making. On the other hand, a financial statement, also known as a balance sheet, is a historical document that summarizes the financial position of an individual or organization at a specific point in time. It consists of three main components: assets, liabilities, and equity. The financial statement provides a snapshot of what is owned and owed and the net worth. It is used to evaluate financial health, manage debts, and analyze the performance over a period. While the budget is forward-looking and predictive, the financial statement is backward-looking and reflective. Together, they offer a comprehensive view of financial planning and performance. In the financial statements of businesses, the balance sheet, or statement of financial position, is a fundamental tool that reflects the financial condition of the company at a specific point in time. However, not all accounts appear on this statement. Some accounts that do not appear on the balance sheet include expense and sales accounts, as these are shown in the income statement. Additionally, profit and loss accounts have no place on the balance sheet because they are integrated into equity and reserves. Temporary accounts such as revenues, expenses, and other transactions related to the short-term financial period are part of cash flows or the income statement, not the balance sheet. These other statements help complete the overall picture of the company's financial situation. Financial statements, particularly the balance sheet, can be evaluated based on various key indicators to determine if they are strong or weak. A strong balance sheet often features a high level of assets compared to liabilities, implying good liquidity and financial stability. Key components that contribute to a strong balance sheet include a high current ratio, current assets divided by current liabilities, low debt-to-equity ratio, total liabilities divided by shareholders' equity, and consistent profitability and revenue growth. Additionally, having substantial cash reserves and diversified assets can also be indicators of a strong balance sheet. Conversely, a weak balance sheet may display a high level of liabilities in comparison to assets, indicating potential liquidity issues and financial instability. Key signs of a weak balance sheet include a low current ratio, high debt-to-equity ratio, and inconsistent or declining profits and revenues. Limited cash reserves and heavy reliance on debt financing can exacerbate these weaknesses. In summary, the strength of a balance sheet can be quantitatively assessed through financial ratios and qualitative aspects such as asset diversification and liquidity management. Besides the ratios, the industry context also matters. For instance, a tech company may have different standards for what constitutes a strong balance sheet compared to a manufacturing firm due to the different nature of assets and liabilities inherent to those industries. Therefore, while financial metrics provide a snapshot, industry norms and context are also vital for a complete assessment.